Welcome to Section 1 of the ASC 710 Compensation Training Series. This section introduces the general compensation framework under US GAAP, covering what a SC 710 applies to, its relationship with related standards, and the key terms you need to know before diving into the detail. By the end of this section, you will be able to explain what a SC 710 covers and, equally important, what it does not cover. You will be able to state the core matching principle that drives compensation accounting, identify the related standards and know when each applies, define the key terms used throughout the handbook, and describe the two primary areas a SC 710 addresses. A SC 710 provides general guidance for compensation arrangements that are not addressed by more specific standards. The two primary areas it covers are compensated absences, which include vacation leave, sick leave, and sabbaticals, and deferred compensation arrangements, where employees defer receiving current pay to a future date such as retirement. A SC 710 does not cover pensions, which are governed by a SC 715, stock-based compensation covered by a SC 718, or restructuring termination benefits, which fall under a SC 420. The core principle underlying all of a SC 710 is the matching principle. Compensation expense must be recognized in the period the employee earns the benefit, not when the employer actually pays for it. This means that if an employee earns vacation time in December but takes that vacation in February of the following year, the expense belongs in December. The period that receives the benefit of the employee's work must bear the full cost of that work. Getting compensation accruals right matters because errors flow directly into both the income statement and the balance sheet. If compensation is underaccrued, expenses are understated and profits are overstated, making the company appear more profitable than it actually is. Liabilities are also understated, overstating net assets. Conversely, overaccrual overstates expenses, understates income, and inflates liabilities. In either direction, the financial statements mislead lenders, investors, and other stakeholders who rely on them. A SC 710 does not operate in isolation. It sits alongside a family of employee compensation standards, each covering a specific area. A SC 715 covers defined benefit pensions and other post-retirement benefits. A SC 718 covers stock-based compensation such as options and restricted stock units. A SC 420 covers exit and disposal activities, including severance paid when management restructures or lays off employees. A SC 450 covers contingencies, which applies when a compensation obligation is uncertain rather than probable. Two of the most commonly confused standards are a SC 715 and a SC 718. A SC 715 covers defined benefit pension plans and other post-retirement benefits such as employer-paid health insurance after retirement. It has its own complex actuarial measurement rules and funded status requirements. A SC 718 covers equity-based awards including stock options, restricted stock units, and employee stock purchase plans. Whenever a specific standard exists for a type of compensation, that standard takes priority over a SC 710. A SC 420 applies specifically to one-time termination benefits arising from management decisions to restructure or lay off employees. Recognition under a SC 420 requires the termination plan to be communicated to employees in sufficient detail before a liability is recorded. A SC 450, the contingency standard, applies when the employer has a potential compensation obligation that is possible but does not yet meet the probable threshold. Applying the four criteria test under a SC 710 helps determine which standard is most appropriate. A compensated absence is any period during which an employee is away from work but still receives pay. Compensated absences are classified in two important ways. A vesting absence is one where the employee retains the right to the benefit regardless of whether employment continues. A non-vesting absence is forfeited if the employee leaves. An accumulating absence is one where unused time carries forward into future periods if not used in the current period. These distinctions determine whether accrual is required. Deferred compensation refers to arrangements where an employee agrees to defer receiving part of their current compensation until a future date, most commonly retirement. The employer recognizes the obligation over the period the employee renders service. A rabbi trust is a common funding vehicle. The employer sets aside assets to meet the future obligation, but those assets remain subject to claims by the employer's creditors. Because of this creditor risk, rabbi trust assets are not removed from the employer's balance sheet. A termination benefit is compensation provided to an employee in connection with the ending of their employment. Special termination benefits are offered on a voluntary basis for a limited period, typically as an incentive to encourage early retirement or voluntary separation. Involuntary termination benefits arise from management decisions to lay off or restructure. The accounting recognition for each type differs significantly, and the distinction between voluntary and involuntary determines which standard and which recognition trigger applies. Bringing it together, a SC 710 has two primary areas of application. The first is compensated absences, covering vacation, sick leave, and sabbatical arrangements. The second is deferred compensation, covering arrangements where employees defer current pay to a future date. Both areas are grounded in the matching principle. Recognize the expense and the related liability in the period the employee earns the benefit. Subsequent sections of this training series will explore the recognition criteria and measurement rules for each area in depth. Let us review the key takeaways from this section. A SC 710 covers two areas: compensated absences and deferred compensation. The matching principle requires recognizing compensation expense when the employee earns the benefit, not when it is paid. Related standards including a SC 715, a SC 718, and a SC 420 take priority for specific compensation types. The distinctions between vesting, accumulating, and non-vesting absences drive the accrual requirement, and both overaccrual and underaccrual produce misleading financial statements. Thank you for completing Section 1 on the ASC 710 framework and scope.